Hey everybody, this is the 5 rules for trading cryptocurrencies. I'm Neil. I've been trading in the more traditional stock and options markets for 16 years now. So I've lost a lot of money over the years developing these rules, learning myself. So hopefully my experience can help you uh, avoid that pain. These rules are actually not just for crypto; they're for trading anything, any kind of short-term or even medium term trading. Um, I see a lot of people who are trading cryptos that are new to trading just in general, and so they might not have gone through this kind of learning process already. Hopefully these following these rules will keep you in the game and not blowing yourself up, which in the trading world means losing all your money. So because losing all your money, taking time to build up more money, and going back into the markets. It's a very painful process. Most long-term traders have done it once or twice, and I just want to make sure that you avoid those problems. Rule number one: the first loss is the best loss. When you go into a trade, let's say you're doing Bitcoin here, and you say, oh, Bitcoin's going to go higher. I'm going to buy some, and then the price drops. So let's say you bought in here, and then the price drops, and it comes back up a little bit. You're like, oh, it's going to come back, and then it drops again, and it comes back up, and you're hopeful it drops again. You always have to go into a trade knowing that you could be wrong, and that the uh, as soon as the market proves to you that you're wrong, you have to exit the trade. That's the rule because one day, I mean, it's at 18,645 right now, but tomorrow it could be at 15,645, and it's a very volatile asset. You have to have that discipline within yourself to cut your losses and let your winners run. That's rule number one. Rule number two is position size management, the 2% rule. So that goes into what is that first loss going to be? How do you know that you're wrong? And the way to do that in a safe way is that the 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 stop loss that you set for yourself, whether it's an actual order that's been entered or just a mental stop that you have, they say, okay, if it hits this price, I'm going to sell or transfer it to something else. That amount that you lose if you're wrong can be no more than 2% of your total buying power. Let's say you have $10,000 and you're playing with, and then you can risk up to what is that, 200 or 20? Okay. Let's see, 10,000 times 0.02. It's $200. So if your trade goes down by $200, you have to exit. And when you get a little bit more sophisticated, you can bracket that to support and resistance levels. So rule number three, your trade is a hypothesis in the market. So you say, I think Bitcoin is going up, or I think Ethereum's going up, or whatever. Um, then that's fine. The but what you're doing is you're placing a bet essentially in the market because these investments, at least for the most part, are not generating any yield. You're just speculating. So it's not like you can hold on to it and get and take a dividend. So um, your your idea that, oh, it's going to go up because of X Y Z, it's going to go down because of A B C, whatever the case may be. Um, that's your trading hypothesis. And by placing money into the market, you are testing that idea against everybody else in the entire world, because everybody else, is the potential trading universe of Bitcoin or Ethereum or whatever else. So just know that the market will respond and tell you if you're right or you're wrong, and you have to respect that information because a lot of people say they get stuck in trades where because they didn't take that first loss as the best loss. They say that it's like, oh well, I put in money and yeah, it's down or it's and but it's coming back because of something, right? And people will rationalize to death. You just have to respect the fact that it's just a hypothesis. It's just an idea, and you might be right, you might be wrong. You can be wrong most of the time and still make money because by following the position sizing and the letting your winners run model, those winners vastly outperform your losers. All right, number four. So legging into a trade. This goes into the first loss being best loss, position size management, and your trade is a hypothesis your trade is a hypothesis in the market. So depending on what kind of trade you're doing and what kind of time frame you're looking at, then a good strategy is always to leg into a trade. So especially since the commission structure in crypto exchanges are percentage based rather than absolute dollar based for the most part. There's really no downside to this. So you say, okay, it's trading at 18,672, and I think it's going to go to 19.5, let's say, which is a nice gain. So I'll put in, if my total potential position size is, $2,000 U.S. dollars, then I might put 500 in to begin with, and then the market goes down, I stop out, and I'm safe. I'm only risking that $500. But if I'm right, so I put in the 500, starts to creep up, goes to 18,750. Okay, maybe I put in another $500, and it keeps going up. Great. So I'll put in another $500. It keeps going up. Great. So put another 500. Now I'm at my maximum $2,000 trade, and by doing that, you conserve your buying power, and yeah, you give up a little bit of gain, but the safety you gain for that means you won't blow yourself up. Because remember, when you're trading, it's a game of singles and occasional doubles. It's not home runs all the time, and that's a rookie mistake that you think that, oh well, Bitcoin's up 3,000 or 25% since last week, so I should make 25% a week. Well, maybe, but that's typically not what happens. So uh, you know, you have to respect the semi-randomness of for the price action. So you know, be cognizant of that, and don't take it personally when trades go against you. And then number five, the trend is your friend. Look at the bigger and the smaller picture. So let's say I'm a day trader, right? I'm looking at the daily chart, and I think my trade is going to last for several hours, up to maybe several days, somewhere in that time frame. Well, okay, you want to make sure that you are with the trend both in the macro and the micro sense. So I'm looking at the daily chart and I say, okay, well, I'm here and that looks good because I have this little trend line going right here, and we're at the support of that trend line, so I think it's going to bounce higher. Okay, great. So you want to look at the time scale that's one size bigger and one size smaller. So let's look at the bigger one first. Say, okay, I'm looking at the weekly chart now. Now, on the weekly chart, is the trend the same? Am I trading in the direction of the general bias of the market? And we can see that, yeah, it's going up. So yeah, it's a bullish trend here. It's a bullish trend on the daily. And then for timing purposes, you want to look at the size that's the trading window that's one size smaller. So if I'm looking at daily, one size smaller is hourly. And if you're looking at hourly, one size smaller would be by the minute. And if you're looking at minute, you can actually break them down in second. Well, in stocks you can. I'm not sure about the exchange support of the charting platforms for crypto, but whatever the case may be. So on on these hourly chart, it's like, well, I'm going to use this for my timing. I'm at the high right here. If I'm super bullish, then maybe that's okay. But if I want to eke out a little bit better performance, I might wait for one of these dips. If you bought down here, that would have been great because that was what? That was 18,383, so that's a $300 discount. That could have been a nice little gain there. So you look at your main timing window for what kind of trade you want to enter. Use the time size bigger to look at the overall trend, make sure you're in the same direction, and then use the smaller one to time your entry and your exit. Um, and that's the five basic rules. I mean, this comes from a lot of experience. will develop more of a feel for how the market acts as you are involved more in the trading. Um, but by following these rules, but especially the position sizing and the taking losses early, you will preserve your buying power and stay in the game for when you do hit that occasional home run. So anyway, I hope that helps. If you have any questions, leave me a message below. Thanks.